Hi, I'm Jennifer Warren, and I just want to talk a little bit about the conference I just attended at the Richmond Federal Reserve Bank. And it was May 22nd and 23rd, and it was called Tech Enabled Disruption and the Macroeconomy, basically. And this year, it was hosted with the Richmond Fed, the Atlanta Fed, and the Dallas Fed. So that is three districts of, I believe, 12 Federal Reserve districts in the United States. And these three districts represent the mid-continent East Coast, the Southeast, and Texas, the Sun Belt states largely. And where a lot of this new reindustrialization activity is also happening, that has been happening as a result of the pandemic, when reshoring, nearshoring has started raising itself as an issue, trying to redress some of the supply chain issues which got revealed during the pandemic. At this conference, obviously, discussing technology and its impact on the economy is a very large topic. And the energy transition, which there were two panels for that, is also a very large topic. So I'm just going to sort of give a little bit of an overview and some of my impressions. And then in future videos, I'm going to delve more into technology and the energy transition and how they're relating and how I see them playing out together. But obviously a big discussion was the path of interest rates. And the president from the Richmond Fed and the Atlanta Fed president, Raphael Bostic, spoke. And obviously they weren't going to give up what they're going to do at the next meeting coming up in a couple of weeks. But one of them was kind of feeling like, they'd like to sort of hang back and, watch and let time reveal what's happening with these lags post interest rate rises. And the other was wanting more information, more data to prove that inflation was in fact slowing down more, where they would be comfortable. So it was kind of a bit of a mixed bag on that front. And so one thing that was kind of interesting from President Bostic was he was just saying that, one of the themes of the conference was uncertainty, and uncertainty undermines long-term investment. And so given that there's interest rate uncertainty and other inflation uncertainties, those are two whammies, to business decision makers. And so Bostic was just saying, we don't want investors to be pausing, and so they're trying to obviously give the certainty that they can. And so that was kind of an interesting idea, because I think you see that reflected in markets. And this is something that myself and Michael of Seeking Alpha will probably address in the near future when we discuss energy and some of this technology enabled disruption. And then the other thing that was noted was that, the tightening is just starting to play out. These lag effects are starting to play out. Obviously, we're seeing those in commercial real estate. There was actually a business leader from Cousins, a publicly traded large real estate firm, and he was talking about that it was an executive from Cousins, and he was just talking about how in office buildings they're definitely seeing some reduced activity, and some of this is obviously because of the pandemic, because of the remote work, and that was also discussed quite a bit. And I guess with Cousins, they have a lot of what they call trophy buildings, so that was some of that commercial office building challenge was not hitting them as hard as some other firms. But that's definitely a big shift. And so I think you're going to see a lot of office buildings getting repurposed in the future. And actually a conference I was at at South by Southwest, the Ivy Fine conference, that was also happening, that some of these office buildings are going to get repurposed. So there will be this great recycling, I think, coming up in some of those spaces. The other thing that was discussed a lot was AI, and sort of one of the comments from one of the Fed presidents was just that, just from a big picture view, that AI feels transformative. And, just from sort of an economic point of view, it's obviously this idea of creative destruction, and we don't really know what that's going to look like. We can't really project that right now, and how fast the speed of all this is really going to happen. Speed was another issue that was raised relative to how technology is impacting the way we work, the way we live. And this obviously really played out in the SVB, the banking crisis that happened. One thing that was mentioned was that if you look at the financial crisis in like 2008, 2010, that played out over a period of time, all the economic effects and the economy slowing down and everything. And how fast we knew what was happening with various stresses in the banking system. And with SVB, it was like one of the presidents said, it was like within 36 hours, there was no longer a bank, so to speak. And that happened as a result of social media, the ability to receive information fast and make decisions. So that was not like It's a Wonderful Life type bank run. It was a whole different animal. And that sort of works back to something that one of the keynote speakers was Gillian Tett, and she is the U.S. Financial Times editor at large, and she has a background in anthropology. And she was just discussing how with the SVB banking crisis, that was the Bay Area, and the thinking and the technology focus and the crypto and the VCs and all that, they're their own culture. And so you saw a little bit of a change compared to, maybe what it would look like in Kansas or something. So, things moved lightning fast because they were all over social media, discussing what they were going to do, and, move your deposits, check out fast, that sort of thing. And so it's a different dynamic, the ability to hear information quickly, which gets back to, you want to have a credible source, which gets back to the challenges of AI and potentially bad actors using it, so there's going to be a lot of policy, I think, surrounding what happens with AI. And then there was one speaker that talked about generative AI and these like Chat GPT and things like that. And we'll look at that another time. The other thing to note was just that, we think of commodities like oil and gas and metals and corn and cotton and all sorts of things, but time is like a commodity when you think about it in terms of technology, and how fast things can happen. And that was highlighted in some research that one of the dinner keynotes gave. It's a professor from the University of Chicago, and he was just discussing how traders, how they're really trying to speed how fast trades happen, and so that time is becoming a commodity, and that has to do with digitalization and fiber and all that sort of thing. And it also gets to data, fast data, big data, data analytics, using all that. But the other thing that struck me too, just with what Jillian was discussing with looking at various cultures and how relationships are changing, what we value is changing. She noted, that Adam Smith said, we've moved from bartering to, store of value through money. And now, the store of values are becoming different, and there does exist bartering in the form of people with their smartphones having data, and those firms that want to use that data for knowledge to target products and investment and that sort of thing. And so the idea that in fact barter, what we have and what we'll give up, is changing. And I think that becomes clear too in some research that I profiled not too far back, and it was about oil and gas companies that pledge net zero and or to reduce carbon emissions, that when they announced their plans for net zero, or just that they were going to reduce carbon emissions, depending on how credible their plan was how the market reacted. And I was talking about this in a video not too long ago, just that if you don't have a credible plan, the market can tell, and your stock price will get hammered. And so that's about reputation, and that is a commodity in a way, especially in financial markets, because it's based on belief. There's a lot of people placing bets. What do you believe? And we saw this play out too with the pandemic. Myself and Sean Wang discussed this in a Bellwether's video about the change of the triple Q, which is a proxy for technology stocks, versus the XLE, which is a proxy for energy stocks, and how during the pandemic, triple Q was way up, energy was way down. And then as the pandemic started to wane, you saw, the desire for hard assets and energy going back up. And then, as we know, all these valuations have been shaved. A lot of the certain tech firms have had their valuations shaved, and they're having to readdress all that. The market's sort of demanding that. And so that's another, aspect of all this that I think is playing out with respect to perception and time, market reactions. What is a commodity? What is valued? And so I'm trying to think if there's anything else. Oh, and one other point to note, and this is about inflation. It was brought to light by one of the speakers that has expertise in the semiconductor industry, deep expertise. And he was just talking about how Moore's law is kind of hitting its limits. And that has to do with the speed with which these chips can contain, do so much and in such speed, and that's kind of hitting its limits. And that electrification is expensive, and we're going to see that playing out. That discussion I started having back in January when I was discussing Brookfield's view of infrastructure, and that decarbonization, deindustrialization, but also electrification, all these things are inflationary. So that is a headwind ahead. And I will be talking about that a little bit more as well. And as always, the unknowns play into uncertainty. And we saw that, when we had a pandemic, and how that's all shaking out still. And then B, we saw that in energy when Russia invaded Ukraine, and we're seeing all sorts of changes to trade routes and pushes towards more electrification, renewables, but also with the IRA legislation, the Inflation Reduction Act, we do see other energy sources being targeted that will be part of the future mix. And so there's an awareness that, there's an all of the above strategy in the United States. So the other thing I would notice too about this conference was, obviously, Virginia and like West Virginia, South and North Carolina, Maryland, those are all part of I believe it's the fifth district. Yes, the fifth district where the Richmond Fed is. And just a different feel on the energy front relative to the 11th district, which is Texas and New Mexico and part of Louisiana. And the Dallas Fed with the Kansas City Fed had a conference back in November, and I did a couple of videos discussing some of the findings from that. But I really noticed a different sense of the energy transition as presented by the fifth district compared to that presented by the 11th district. And I'll probably be talking about that a little bit as well. Thank you for your time.